from me too. Warm welcome to everybody here and good afternoon. Thanks for tuning in to an update of SKAGEN Global. We're going to go through today the agenda with a few reflections on the market, talk about the fund, and then finally the answer to any questions that you might have. And I guess from the overshadowing concerns, currently that's what we hear from a lot of clients and people we talk to is about, what is happening with the market. Are we close to a bottom? When are things going to turn around? And of course, what about the fund? How about performance? And when is that turning around as well? So we'll try to address all of those concerns in this update. And again, feel free to add on any additional questions at the end. But let's start by kind of having a look at the overall market around the globe and see kind of how things have played out so far this year. And this is in NOK, but it's still sort of giving you the general kind of overview of how things have developed from a number of the key markets where we've had a bit of a reversal compared to last year and the previous years, maybe I should say. Now we've had Turkey and Brazil leading the markets, and then Norway has done fairly well also, and then sort of things have been getting progressively worse as we move from left to right, and obviously we have Russia at the very bottom here, and no trading has been suspended there, and same for the Ukrainian market here, but a tough start to the year, and let's sort of look into what is sort of the other things happening. Well, one thing that we've seen a lot so far has been some extreme volatility in the market. This slide here shows you the 24-hour swing that has been recorded on the Nasdaq index, and as you can see from these green arrows, we've had a couple of the most kind of violent 24-hour swings that we've seen over the past 20 years here at the end of April and early May. So it gives you somewhat of an indication that it is a kind of shaky mood and shaky time out there in the market, given that the other swings with this type of magnitude, they have taken place during the IT crash, during the financial crisis. So that clearly is something to keep in mind. Then if we move on and kind of think about what about the sentiment, and I guess needless to say, it is negative and actually very pessimistic on an historical basis. These graphs, they show you the outcome from the most recent global fund manager survey that Bank of America does every month when they reach out to a few hundred global investors to try to get a feel for the mood and what people are thinking. And a good thing with this one, if we look at it, is kind of given the long trends, the long time periods that you can see on these charts, they go back, 20, 30 years in some cases. So it's sort of, you can get a good way to move away from the otherwise fairly myopic day-to-day news in the market. Just to kind of pick out a couple of examples here, if we take the one up on the left corner, looking at the investors' optimism for growth, or maybe better, lack of optimism for growth. We're at the rock bottom here, reading back in April, kind of going back all the way to 94. We have hardly seen this type of pessimistic outlook when it comes to economic growth in the world. And there's this huge sort of uptick here in the fear around stagflation taking place. I guess you got to go back again to the financial crisis to see anything close to the current level. And kind of here in the bottom right corner, where we have the biggest perceived tail risks in the market, you can see sort of in light blue the March reading, and in dark blue or navy you have the April, the most recent ones. And what we see there, fear of recession, central banks raising rates a lot, being hawkish, inflation, those remain the key concerns. Might also be worth noting that the Russia-Ukraine conflict or war has been receding in terms of fear factor or risk perception for investors, dramatically over the past month, at least between March and April. And can of course speculate why that is, but we think that one reason would be the fact that you've had quite a strong resolve from the West, the unity that maybe wasn't expected, back in during the March data. We've also seen the miserable performance of the Russian army so far in the war. So maybe that gives investors a bit of a relief that it may not develop quite as badly as people had expected in the initial phases, or maybe that it won't spread more broadly geographically. But in short, big fears kind of around recessions, lack of growth, inflation, central banks trying to fight the inflation, but risk, of course, sapping growth and maybe turning the economy back into a recession. So again, let's then sort of do a deep dive into the recession, or the inflation part. This is a graph that shows you the US CPI, the Consumer Price Index, on a year-over-year basis, going back to the early 80s. So a fairly long time series again. And here you sort of see the gray bars in the background. They are visible if you squint. They are times when there was a recession taking place. So there have been a number of those during this time period. And of course now, with inflation kind of being at this peak level, looking at previous peaks, they tend to be where you've had some type of recession happening. So based on this limited history, I mean, there's also been a few false dawns, but there is of course an heightened likelihood or risk that we kind of will somehow get into that type of tough economic scenario. But of course, inflation is high, and the conventional way to fight back against that is to raise interest rates. And we've seen that starting to take place around the world with a fairly juicy 50 bips hike by the Fed. Here in Europe, we've also had different countries beginning to hike the rates, and you can see here what has kind of been the change in interest rates. So in basis points, the color code or the legend being up here, and this is then since the start of 2022 until April. So it is sort of ticking up around the globe, which again, it was something that will impact equity markets, given that they become on a relative basis less attractive compared to when you have higher rates kind of going up. And again, taking a kind of a look back at the interest rate level, this is for the 10-year American government bond yield, often cited, but also again useful to have this type of long time horizon. And we've seen how it has come down since the early 80s, and it kind of troughed here a couple of years ago, and now back up a bit here to around 3% today, which of course in a context, if you take 70, 80 years, is still very low. But if you kind of look at it, maybe the past couple of decades, which is also a not a very short time period, it's still sort of 20 years, and it's kind of back to a level that is not totally out of sync with where it's been during that time period. So of course, I mean, question that is in everybody's mind is, we've been used to some pretty good markets over the past few years. Are we seeing the light at the end of the tunnel? Is it about to turn around? It's a fair question, and as you know, we as SKAGEN Global, we don't have a magic crystal ball that we can look into to get this type of macro information. We don't try to, and we're not sure that anybody can really correctly make these type of macro calls consistently. But looking kind of at the data, like I was saying on the previous slide here, that we are now again looking at the 10-year yield kind of back at the level which is looks more sort of reasonable compared to where we have been in the past couple of decades. So that is one thing to take into account. Another thing to think about, maybe this is more from a mental point of view, is to just look at how strong equity markets have been over the past decade, obviously fueled by a number of factors that we all know what they are, from monetary policies to digitalization and so forth. But it is pretty amazing to look at the this is the MSCI World All Countries Index going back 10 years, and kind of looking at the annualized rate of return. I mean, in euro terms, it is about 14%, which is very impressive compared to the long-term average, which tends to be kind of in that 9 to 10% range. And here, I mean, obviously, it goes without saying that if you're going to get to the long term, if you believe that the historical long-term average will also be a good indicator or guide for the future average, then there's got to be some year or years when returns have to be significantly below what they have been more recently to kind of get the average back down. We can discuss, and that may be kind of a separate discussion, whether the historical rate of return is an adequate or a good guide to the future. There is an argument why it could be or should be higher going forward, but kind of thinking that it's going to be anywhere close to these levels, I mean, that is probably a little bit too optimistic here. So in summary, it's not unreasonable to think that it's going to be that there has to be some type of correction for the market to basically take a breather. It might have been a little bit overheated in the past, year or couple of years. And one way to kind of look at this and also kind of put things in perspective is, again, to take that longer view. This is the MSCI All Countries World Index going back to 2002, so 20-year history, and clearly big drop here during the financial crisis. And where we are today, up in the right here, it also looks like it is a kind of steep decline, but then kind of over the past 15 years or so, or whatever it is, 13 years, there have been a few kind of small hiccups during the time here, but it doesn't look too bad when you kind of look at it in the rear view mirror. But this can also be deceiving. I mean, just to give you an example of this, if we look at this kink in the graph, or kind of the dip here in 2011, and we zoom in on what happened during that calendar year, we look at the kind of from peak to trough of the index during 2011, the market fell by 24%. Yeah. So it was a pretty dramatic pullback, during that market, which maybe doesn't look quite that bad when you're not going to look back at it, but it was a meaningful hit, and without that many kind of remember even why this happened. Probably the only ones who remember are the ones who decided to panic sell at the bottom. They may remember, but most probably investors who were more in a buy and hold mode and could sit through this, they have probably forgotten about what happened during this time period. Then if we kind of look in sort of superimpose this on this year, 2022, until yesterday, the global index was down 18%. So, I mean, it's still not as bad as it was in 2011, even though things feel kind of very worrisome at present. So it's just kind of a way to, again, put things in perspective and recall that markets, they go up and down. Nothing goes up in a straight line, and there has to be some down period at some point. Otherwise, things would just be too good to be true. And we also kind of want to wrap up this section by again showing you this slide about the amazing long-term compounding ability of stocks. It's a graph that it always sort of surprises us. We've seen this one many times, but just thinking about it, the immense kind of power of it, and the way that stocks will protect you from inflation is something, again, worth keeping in mind during these periods when there is a downside in the market, catastrophic headlines in the newspapers and so forth. And that's often a helpful way. Then let's move on to the fund and kind of put that into this context here. And as you know, at SKAGEN Global, we don't try to time the market. We're not out to be market timers, to jump around and to make short-term bets or trading. What we do is, we have a core of a portfolio where we try to identify the long-term kind of winners, companies that can compound over time and deliver a lot of value to the shareholders and value to the customers. I mean, those sort of go hand in hand. If something is sort of a very big dislocation, then we may kind of go in and spice up the portfolio here, but the core will be around these kind of the long-term winners, which are very few kind of in the market, the way we look at things. This graph is, again, this is one we have shown you before. We think is kind of worth bringing it up again, especially sort of given the rough start of the year. And remember, this is not the fund. It is just a graphical illustration of how we believe, think, and hope that the fund kind of will perform over time and exhibit itself. So, it will not go up in a straight line. There will be times when it is sort of a one step backward. And where we'll have the green dot, that's probably kind of where we were at the end of last year. You may remember from our previous update that 2021 was a very good year for the fund, 12% outperformance toward the index. And of course, we were sort of probably kind of in this range on a sort of graphically speaking, or figuratively speaking. Whereas then we've had a kind of a shorter pullback, and it's not something that we think is entirely unexpected. It is very much in line with what we have communicated, and we hope and think that we are kind of now at some point here beginning to reverse this and move forward and upward again. So with that, kind of to show you the performance, this is in euros, shows the kind of year to date, 1 year, and then the time periods longer than 1 year. They are all annualized to kind of show you what the average is. And this is by then the end of the most recent month, so end of April. And you see that the fund has, like I said, pulled back, and it of course also then warrants the question, well, why is it? I mean, what is the reason behind this performance? And to go into that, let's look at some of the names. There hasn't only been sort of names that have been performing a bit poorly, but it's also been some good names. Canadian Pacific, our railroad in North America, has been doing well. Waste Management, which is obviously waste handling in North America, also been progressing well. Mastercard has had a pretty good start. We thought that they executed well also during the Corona times, but the stock, if you remember last year, it was sort of treading water or not really moving up a whole lot, even though it was performing pretty well, and is sort of getting some credit for that execution and the performance, financial performance so far in 2022. Then the bottom ones, from an absolute point of view this year, JP Morgan, Intuit, DSV. These companies, based on the reports we've seen so far, we think they're doing fine. Yeah. Intuit probably was one of those a little bit kind of more highly valued at the end of last year, so it has kind of pulled back in concert with some of the other names in the technology sector. Looks a bit overdone kind of at this point. DSV has had a good track record for many years, and we think the company looks very strong at this point. So the reason that it has pulled back, well, probably some of it has been related to the multiple contraction that has happened to many of the names that have had a little bit higher multiples. Also coupled with probably some profit taking. Both DSV and Intuit, they were sort of great performers for several years, and it's possible that now then people are getting a bit more concerned about the market, that they maybe sell some of the winners to pocket some of the profit. That's a plausible explanation for at least some of the pullback. But overall, nothing is wrong in sort of these investment cases. We continue to have faith in everything. I mean, both the top and the bottom three that we've seen so far. Even though it might seem counterintuitive, then like if things are going fine, like why is the stock sort of pulling back, and in some cases meaningful pullbacks, I mean 20% or more. Well, we thought we wanted to kind of show you again this graph of Nike, which we also own in the fund, but just to again illustrate this point. This is the Nike share price, or the drawdowns for the Nike share price. That means it is the peak to trough decline during a kind of specific time period, and it goes back to 1986 all the way to 2021. And as you can see on this chart, I mean, the Nike share price has not been going up in a straight line. There have been some pretty considerable pullbacks in the share price intra-year, or in the time period of a couple of years that have been quite large. I mean, many times 10, 20%, even 30%, not totally uncommon, and a few times they're down to 40% from peak to trough. And that can of course be bad if the company share price is going back or pulling back because of poor fundamentals, poor execution, poor financials, and so forth. But in many cases, it is more related to the regular kind of rotations that happen in the market. If you think about it, I mean, there has to be a rotation happening in the stock market every once in a while. Otherwise, you would have the same stocks outperform every single year. And that's, of course, logically not possible. So you're going to have to see some of these rotations, and the rotations will have to be violent or powerful or large, because otherwise there wouldn't be any incentive for anyone to trade and out into other stocks. But it doesn't mean that it has to be a bad long-term investment. Take the Nike share price, goes back to 1986 again. So think about this graph, the big drawdowns, and then how has the share price developed? Well, pretty nicely overall. Yeah. Just when we look back at the overall stock market, and remember that 2011, it looked like a blip, but it was a pretty big downturn. These things here look like blips these days, but they were probably pretty dramatic in many other ways. But again, for those who are long-term owners, you find something that is fundamentally well positioned, undervalued, has a good avenues to continue to expand. You just sort of sit through the share price gyrations that are bound to happen in the market. So that's what we think. There's some of this going on right now, kind of happening at the same time, which is a big sort of explanation for the pullback. Because when we look at the reporting season so far, overall, the fund, the companies have delivered, we think, good reports. In some cases, maybe average, but in several cases good, and in a few cases, very good reports. So we don't think that there's anything fundamentally wrong with the companies or execution, but it is more a matter of a technical pullback and some of the high multiples, a little bit higher multiples coming in to some extent, and profit taking and like regular rotations happening. So nothing that really sort of concerns us, given that we have a long-term time horizon, even though of course we also want everything to go up, and we don't want anyone to see stocks or portfolios go down, obviously, but it's also part of the game and part of what it takes to be a long-term investor. And one more thing to add to this, and also one thing that gives us confidence that our companies are, we think, well positioned, well prepared to ride out the storm which is now brewing around inflation and hawkish central banks, is if you look at this chart, and this is not everything in the portfolio, it is a sample of the names that we have. You can see the year that the companies were founded. On average, the median, if you will, it was 1968. So companies have been around for more than 50 years. And some companies were founded back in the 1800s. And they're still around today. A number of them in the sort of early to mid 1900s and still around. And then we have the relative newcomers, if you will, but they are still 20 years old. So we're not looking at a portfolio with the type of speculative startups. I mean, what we have are companies that have withstood 2 world wars and a number of other type of economical, financial, military, and political crises. And we think that what we have now, they are again adequately prepared to weather through and sort of ride through, you know, a few whatever it might be, months, quarters, who knows, maybe a couple of years of higher inflation. And that is something that they have been prepared for a long time. Then looking at what we've done in the portfolio during Q1, like we remember from that graph in the beginning about Nasdaq showing you how violent some of the swings have been, that has of course given us a few opportunities. Even though we don't trade a whole lot, there are times when we take advantage of the market, and we added Partners Group, a Swiss investment firm, Marsh & McLennan and Dollar General. Marsh works with risk advisory, insurance, brokerage. Dollar General is a sort of a low-cost consumer store in the US, and we think that these are all obviously strong additions to the fund. We exited 3 positions, Munich Re, German reinsurance company, where we saw that the price target that we have, stock was doing well, came close to the price target, so it wasn't as attractive anymore for us to own, so we exited. UPM, here we've seen some mixed execution, and Autodesk was an example where nothing was necessarily wrong, but we thought we had better examples or better opportunities to put into the fund. And then we kind of took down position size in the salmon farmer Bakkafrost and the insurance analytics company Verisk in the US. This means that the fund currently looks like this. You can see where we have most exposure in financials, in information technology, consumers, industrials, and we are an active fund, which means we are not in any way trying to hug an index, but we look bottom up to find the what we think are the best long-term ideas, and that's what means that we may be naked in some sectors. That can change going forward, but this is the current setup, and I'll come back to the energy sector at the end, since we've had a question come in on that topic. The top 10 list, as it looked in April, we continued to run a tight ship with a concentrated portfolio, 44% in the top 10 list, and around 30 names in the fund. As you will remember from our previous presentations and dialogues, we place a lot of value of having companies with a strong competitive advantage. And as you can see from these key metrics about profitability, we remain a lot more profitable in our firms than the average, sort of the index company, if you will. And on the balance sheet, that's another important parameter for us, to have companies with robust balance sheets. That's especially important during these times when it's a bit rocky in the market, and obviously when the market goes down a little bit, then pretty much everybody goes down with the market. But of course, the more market goes down, the more important it is to have a robust balance sheet, and everybody can sort of sleep well at night knowing that the SKAGEN Global Fund is a fund with companies that have strong balance sheets. And it's maybe also extremely important these days when you have potentially higher interest rates coming. Yeah, if you have a company with a levered balance sheet that is suffering both from sort of an economic slowdown and have to pay higher interest expenses, that's a pretty bad cocktail, and something that we of course want to avoid, and we don't sort of have any significant exposure to those type of companies in the fund. And then lastly, about valuation, I mean, we often show this number here. This is the price target upside, looking 2 to 3 years out. And given the again, significant pullback so far in the year. This number is looking to us very attractive now. There's a large upside in the fund, actually probably the biggest upside that we have seen for several years in the fund. So that is something that we think is encouraging and obviously gives a good entry point if someone we're thinking about adding kind of more exposure to the fund or the market. So to summarize again, kind of what we think currently we continue to consistently run the fund, run the portfolio as we have communicated. The mandate is unconstrained, a high conviction portfolio with bottom-up analysis, and then that multi-year investment horizon. There will be quarters when things can go against you, but over time we hope that that's gonna disappear or be overshadowed by the positive developments. And the big emphasis in the fund on this partnership mentality, which is, as we have explained, that we know that clients want to be aligned with portfolio managers. I mean, we are invested in the fund as well. And same thing, we want the company management, the portfolio holding company managements to be invested in their companies. And that's something we look a lot at, and they are. So we have we think a strong partnership sort of mentality from client all the way through to the portfolio company top management. And then to kind of wrap up this section, we have talked in the past about the importance of having kind of a diversified portfolio. And we think that regardless of whether you're a retail client, high net worth, family office, institutional client, SKAGEN Global can provide a good foundation in such a fund, in a portfolio where we provide the global exposure to some very carefully selected names that we think will provide great performance over time as the companies build shareholder value. And with that, I will touch on a couple of questions before checking if there's anything more coming in. One that has been submitted is about energy, and the question is, in short, why does the fund not have any exposure to the energy sector? And then the answer, I mean, looking at the oil prices, the Brent oil price kind of going back 20 years, you can see that the median during this time has been $66 per barrel. Currently, we're trading at 105, 106 on that level. And not to say that it couldn't go higher. It can go higher, of course, it can go a lot higher, or it can stay at this level for an extended period of time, who knows? But for us, when it comes to oil and commodities, we prefer to get into those names when there is a lot of pessimism in the market, kind of so we can buy low and then we can sell high. As an example, the green dot, this is when we bought into Equinor at the sort of around the COVID crash, and oil was trading at a very attractive price, we thought. But that's kind of when we look to get into these names, when we have to buy in at peak levels. Yeah, then we tend to be more patient and just wait for a better entry point. But also kind of be worth pointing out again, these are two graphs from the Bank of America April survey, that the energy sector is a very big consensus bet at this point, or investment, if you will. Looking at here, you can see how investors are positioned, what are their favorite sectors. And looking on the right-hand side, this is a graph showing you overall commodity exposure on a relative basis for investors going back to 2006. And as you can see here, we are now at the highest commodity exposure or overweight exposure ever for global investors. So again, when everybody's kind of running one way, it's not obvious to us that it's the right time to go in. We then have the instinct to kind of go against the crowd and maybe wait for a better chance to get in. And then the second question is about ESG. Do we take into account biological diversity and environmental considerations? And the answer here is yes, we absolutely do. And the reason goes back to our long-term thinking about, if you think companies that we want to own should be in the portfolio for 10 or 20 years, if you're going to create value sustainably and consistently during that time period, we are firm believers that you need to not only have a good product or service, but you also need to treat your customers, your employees, suppliers, in a fair way, and you need to be a good member of the local community, meaning you need to think about the environment and those other things if you're going to be able to sustain this type of long-term performance. So we take that all into account, and this is the rating that SKAGEN Global has from the independent evaluator Morningstar at the end of the first quarter. So it looks like they recognize that we are at least trying to take into account sustainability as we run the fund.